You just paid off your car loan 3 months early, saved yourself $200 in interest. You feel great. Then you check your credit score and it dropped 38 points. That drop isn't a glitch. It's not a mistake. It's the system working exactly as designed. And the reason why has nothing to do with whether you're responsible with money. Your credit score punishes you for doing the financially smart thing because the score isn't measuring how good you are with money, it's measuring how profitable you are to lenders. Those two things overlap sometimes, but when they don't, the score picks profit every single time. Here's what actually happens when you paid off that loan. Your credit file went from showing an active installment account with perfect payment history to showing a closed account with zero balance. The algorithm saw that change and decided you became less valuable, not less trustworthy, less valuable. The math works like this. FICO scores come from five weighted categories. Payment history is 35%. Amounts owed is 30%. Length of credit history is 15%. New credit is 10%. Credit mix is 10%. The last one is the trap almost nobody talks about. Credit mix means having different types of credit, revolving accounts like credit cards, installment loans like car payments or mortgages. The algorithm wants to see you juggling both types actively. When you pay off your only car loan and all you have left are credit cards, your mix score drops to zero. That's worth up to 10% of your total score, which translates roughly to 40 or 70 points depending on your starting position. And here's the detail that makes it almost insulting. FICO doesn't just want you to have an installment loan, it rewards you most when you have one you're actively paying down with a low balance left. Their own data shows that someone with a nearly paid off car loan is scored as less risky than someone who finished paying it off entirely. Think about that. You're better off owing the last $800 on that loan than owing nothing. The moment you make it disappear, you don't just lose the credit mix. You lose the one thing the system rewarded most, an open loan with a low balance, quietly proving you pay on time. Finish it off, and the signal vanishes. You just lost the two things that loan was doing for your score, the credit mix and the active low balance signal. Banks will tell you this makes sense because someone with only credit cards is less predictable than someone successfully managing both credit cards and loans. That sounds reasonable until you realize what it actually means. You're being penalized for reducing your debt obligations. You're being told you're riskier now that you owe less money. The logic only works if the goal is keeping you in debt. Here's the part most financial advice gets wrong. They'll tell you not to close old credit cards because it hurts your score. That's true, but incomplete. They won't tell you that paying off your student loans early will also hurt your score through the exact same mechanics, or that your mortgage payoff will crater your credit mix unless you immediately take out another installment loan. The system wants you rotating through debt product forever. Pay off your car, finance another one. Pay off student loans, keep a mortgage. Always owe someone something. Just manage it cleanly. That's the profile that maximizes your score. Now, here's where the math gets genuinely ugly. Let's say you have three credit cards and one car loan. Your mixed score is maxed out. You're carrying $12,000 in balance total. 4,000 on the cards, 8,000 left on the car. You get a windfall, inheritance, bonus, whatever. You have $8,000 to deploy. Option 1, pay off the car loan completely. You eliminate a monthly payment of $295. You save about $400 in remaining interest. Your credit mix drops. Your average age drops. Your score falls 30 to 50 points. Option 2, pay down the credit cards from 4,000 to 0. You eliminate high interest debt, your credit utilization drops from whatever percentage it was to zero. Your score jumps 40 to 90 points. The financially smart move depends on interest rates. But let's say your cards are at 18% and the car is at 4%. Obviously, you should pay the cards. But here's what nobody mentions. Even if both loans were the same interest rate, paying off the installment loan hurts your score more than paying off revolving debt. The system is literally weighted to prefer you keeping installment debt active while paying down revolving debt. And revolving debt is the profitable kind because it resets. You can rack up another 4,000 on those cards next month. The car loan just decreases until it's gone. Credit card companies make money two ways: merchant fees when you swipe, and interest when you carry a balance. They make more from the second one. Banks that issue car loans make money one way: interest on a declining balance. Once it's paid, that revenue stream ends forever unless you finance another car. Your credit score is built to encourage the behavior that generates recurring revenue. Pay down the revolving account, keep the installment accounts open and active. That's the pattern the algorithm rewards. This is why people with mortgages tend to have higher credit scores than people who own their homes outright, assuming everything else is equal. A 30-year mortgage with 28 years left is worth more to your credit mix than a paid off house. You are scored higher for owning $400,000 responsibility than for owning $0. Let me be clear about what this means in practice. If you pay off your last installment loan and your score drops 40 points, you might suddenly not qualify for the best interest rate on your next loan. That drop could cost you a quarter percentage point on a mortgage, which on a $400,000 loan over 30 years is about $24,000 in extra interest. You paid off debt early, saved a few $100 in interest, and the credit system responded by making your next loan cost you $24,000 more. The math only makes sense if you understand the score exists to maximize lender profit across your entire lifetime, not to measure your actual financial responsibility. So, what do you actually do with this information? First, understand that your credit score is not your financial report card, it's a marketing score. It measures how profitable you are to the lending industry. High score means you're a good customer, not a good saver, not financially independent, a good repeat customer. Second, if you're planning to apply for a major loan in the next 6 months, do not pay off installment debt early. I know that feels backwards. You want to reduce your obligations before taking on a mortgage, but the algorithm will punish you for it. Pay it down to lower the monthly payment if you need to improve your debt to income ratio, but keep the account active until after you close on the new loan. Third, if you've already paid off installment debt and your score dropped, it recovers over time. The mixed penalty is immediate, but it's not permanent. As your revolving accounts age and your payment history stays clean, the score climbs back up over 6 to 12 months. The drop is real, but temporary. Fourth, if you're sitting on cash and deciding what to pay off, run the actual math on interest costs first. Score implication second. If you're paying 19% interest on a credit card and 4% on a car loan, pay the card, even though it helps your score. The score is a tool for accessing future credit. Don't pay thousands in unnecessary interest to inflate a number. Fifth, if you have no installment debt and no plans to take no on more, let your score drop. This is the one scenario where you can ignore the whole system. If you own your home outright, your car is paid off, and you're not financing anything in the foreseeable future, your credit score doesn't matter. Let it sit at 680. Who cares? You're not using it. The credit score system assumes you'll be a borrower forever. If you're not, the score becomes irrelevant. It's designed to measure your attractiveness to lenders. And if you're not in the market for lending, you're outside the system entirely. Here's the thing they don't say out loud: The credit bureaus and FICO are not government agencies. They're private companies selling a product. Their customers are lenders, not you. The score is built to help banks identify profitable lending opportunities. It's very good at that job. It's not built to help you become financially independent because financial independence means you stop being a customer. That's not a conspiracy, it's just business model alignment. The score does what it's designed to do. You just have to understand what it's actually designed for. Next time your score drops after paying off debt, don't panic. Don't assume you did something wrong. You probably did something right, and the score is mad about it. That's how you know the system is working exactly as intended. If this cleared up something your bank definitely wasn't going to explain, hit subscribe. We break down the mechanics they hope you never figure out.